Good morning. We're making this video for everyone for a Saturday morning. It's actually Friday evening at about 10 o'clock. I'm going to take about 5 or 10 minutes and I'm going to give you a lesson in how to use Bollinger Bands. We're going to describe what they are, what they measure, what they don't measure, and how you might use them. Realizing that many traders during the week find themselves going into the weekend on the right side of a trade and they're trying to determine what they may and may not do come Sunday. Won't be, well, actually Monday, or won't be this Monday, it'll be Tuesday with the holiday. And others, more often than not, get into a trade that isn't going well, and then they really start to buckle down and learn. And so ideally you want to learn these things before the trades go on. But for whatever side of the fence you might be on, I hope this little video helps you. And if it does, be sure to subscribe on YouTube. Be sure to push the little bell button and share it with a friend. And if you have an interest in what else we might be able to help your trading with, be sure to visit stockmarketcaddy.com. I am Bagger Don. All right, this is an S&P. This is the SPY ETF, and it's a daily chart, right? So let's put on a Bollinger Band. I have it preloaded, and let me come here to edit study. I actually have it in here twice, but I'm going to first turn on the first one. I'm going to turn this on, and there you have it. Okay. Now, at first glance, Bollinger Bands might appear to give you direction. They don't. They don't. Now, there are some bands that are meant to give you direction, but that's not what Bollinger Bands are meant to provide. They're meant to provide you a view of volatility, and they're also meant to give you a view of relative overbought or oversold. Notice I said relative. A lot of the other things that you might use for overbought or oversold, the stochastics that can be down at the bottom of your chart, can really get you into a lot of trouble. By the way, our systems, when we have systems, we can do this by hand, but we have systems that can do this by the computer. So one of the things that we know is, well, first let me just explain what the Bollinger Band. The Bollinger Band has a simple moving average in the middle. It's a 20-period moving average, and the upper band is 2 standard deviations away, and the bottom band is minus 2 standard deviations from the close of the average. And what happens with this band is when there is a volatility compression, for instance, right here, you see right here, these are how the two bands come together. That would be known as a volatility squeeze. Not a short squeeze, but a volatility squeeze. And you'll also see another one right here. See that one? Right here? Right in here. I'll click on that so you'll see it in the video. And these volatility squeezes, you might think of them as the start of something. What happens is when volatility pinches, volatility gets really, really tight. Low volatility begets high volatility. And what happens is many times price will explode from a squeeze. And might have been a little bit of a squeeze in here, and it kind of exploded upward. When price, and you look over here, let me bring this one in, this is even a better one. Over here, you can see how it got really, really tight, really, really squeezed, and then it explodes. Now notice price is actually falling, yet the upper band went up, right? And the lower band came down. That's because these bands are not giving you direction. They're just mapping out the volatility. And when that price expands like that, that is known as the bulge, And ideally, you want to be in the trade as the bulge is getting underway, because once the bulge has occurred, the bulge will mark the end of something. When the volatility gets really, really wide and the bulge is at its widest, which is when normally the retail trader will come in and say, that's where I want to short, I want to follow everybody else, and then boom, the market stops, reverses, and goes back the other way. And so they're always on the wrong side. So the other neat characteristic, and we're describing this because once you know these sorts of things, there are different ways that you can trade Bollinger Bands. The other neat thing, let me just kind of drag this into view, about Bollinger Bands is that price moves within the bands 90% of the time. 90% of the time, price will be in between the two bands. 10% of the time, price will punch out. You see, let me get a little pencil here, and I'll do a little red one. So you can see, like right here, kind of punched out. And it punched out right here. And it punched out right here. And it punched out here. Didn't quite punch out. Here was a punch out. Now notice, not all the time, when it punched out, it came back in and price fell. Punched out, came back in, price fell. Little fall, but not much. Little fall, not much. It doesn't work every single time. This one didn't really go out. This one did. Punched out, fall. Friday, we're outside. If we come back in, we very well could be back to the other side of the bottom of the Bollinger Band. Could be. However, let me show you. You say, well, Don, I've been in some of those and it rides the Bollinger Band. So for instance, here it's outside and it just continues. It's outside and it comes, let me get a pencil. I just moved all our little red dots. But so the same is true here. When it punches out here, I'm sorry, we're doing here, punches out, comes back up, punches out, comes back up, punches out, came up a little bit, but yet it continued to ride down. And that's where Bollinger Bands, it doesn't mean just because we punch out and just because it breaks back in, either on the upper or the lower, doesn't necessarily mean you're going to get a big move, but many times you do. But when you are riding the band, usually there's an explosion of volume or an explosion of breadth, and the trade really develops some momentum. So now we're going to come back over here, and what we know with this punch out up here is that the overall breadth of the market isn't very strong. We have only about 50% of the S&P stocks over their 50-day average. We have the IWM breaking down, 2,000 stocks. So we're thinking that this punch out is probably not going to sustain itself. It's short-term overdone. And it's likely early next week, maybe on the holiday with the futures, and you come in on Tuesday and we gap down, that we're going to probably slide back down and visit the lower end of this band. And if we break the band and then the volume comes in and the momentum comes in, then we could have ourselves a really big correction. Now let me clear those drawings and show you another little tool that you can do. Now again, we do this with computers, but doing it longhand can be a little tedious, but let's go in and let me show you something else. We loaded in a Bollinger Band a second time. I'm going to turn this on and let me show you. We changed the deviation, same length, but we changed it to 3 and -3. So now we're going to have two sets of Bollinger Bands, and what we're looking for are the real extreme ones. So let's see, we had a few here, they didn't, but we had too much momentum. They ultimately came back up. So ideally you want to be buying off the lower band. So for instance, like let's look right in here, came kind of punched out and then came back up. Here's one that punched out, came down. Here's one over here, punched out, came down. Here's one that punched out here, came up, punched out, came back a little bit, not much. And this is very, very tight. This is very, very tight. So where we're looking for the punch out is exactly, here was one here that punched out, came back. And a percentage move, this isn't a bad little percentage move, but this is exactly the type of move that we're looking for, where we punch out, we're 2 to 3 standard deviations off the 20-period moving average. The overall breadth of the market sucks. Very, very likely, probable, likely, notice the words I'm using, that we will come in. Maybe on the first day, maybe we go 1 or 2 more days, but likely to come in and test the lower bound. If you like this approach and you want to make it mechanical, you want the computer to help you find these opportunities, you want the computer to help you trade, maybe actually make the trades, and you want to use other systems, be sure to visit stockmarketcaddy.com and be sure to give me a call, 813-758-8263. We are running not a trade service. We're not handing out the fish. We are a mentoring site of like-minded people, and to that extent, we're very unique. We're algorithmic traders, system traders, and it is more of a private club than it is some sort of, alert service where you don't learn much. Once again, bag it on, 813-758-8263. Thanks. Have a great 4th of July.